Good morning. It's Monday, January 27th, 2025. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly market and economic commentary. I can be found intra-week if there is something to say on LinkedIn, Herb Morgan, or on X at Herb W. Morgan. The presentation you are seeing and hearing is prepared by me. It is designed for use by financial advisors as well as individual investors. Each of them, however, are expected to make their own investment decisions. Nothing contained in the presentation should be treated as investment advice, tax advice, or the recommendation for the purchase or sale of any security. The views expressed herein are mine and mine alone and may differ from the views of CFIA's parent, affiliates, or other portfolio managers at the firm. Well, let's get into it. The market continues to rise last week on the enthusiasm around the prospects for pro-growth economic policies, deregulatory policies, all associated with the incoming administration and their ability to enact substantive legislative changes, at least for the first 2 years, given the majority that the Republican Party has in both houses of Congress. So we were up almost 2%. You can see 1.76% in the S&P 500 last week. International developed markets really took off, up about 3%, not quite leading for the year. You can see U.S. midcap still up 5%, but it was a big surge last week in developed international stocks. Some of that has to do with views about diverging monetary policy between the U.S., not likely to cut anytime soon, or at least that was the view last week. In the European markets, for example, looking to continue to cut more aggressively this year. Fixed income did catch a little bit of a bid there. You could see up across the board. High yield, very strong, up 33 basis points. Let's get into some of the economic data. And then, of course, the big discussion of the day is this new revelation over the weekend about DeepSeek, an artificial intelligence engine put out by a Chinese company. We'll get to that here towards the end. Weekly initial claims for unemployment ticked up just a little bit last week to the very low reading of 223,000. You could see just plodding along on that 200 to 250 level, going all the way back to late 2021. Continuing claims rose a little bit from 185 to 189. We got the S&P Global readings. S&P Global is the company. They're not global metrics. They're U.S. metrics, both manufacturing and services for the month of January. U.S. manufacturing PMI broke above 50. 50 is the line of delineation between expansion and contraction. We have not been above 50 since earlier in 2024, not quite a year ago, but it looks like about 9 months or so ago. And we got our first reading above 50, signaling national expansion in manufacturing after about 9 months of contraction. Services sector, which is a much bigger part of the U.S. economy, about 85% of the U.S. economy, fell a little bit to 52.8, but that is a fall in the reading, not a fall in the amount of services produced in the economy. Anything above 50 means the total volume of services grew. So 52.8 is still a very good reading, just not as high as it's been. And it was, however, a little bit below the expectations of 56.5. Consumers who have been reportedly feeling better and better about things you can see the chart here, for some time, were not quite as excited in the month of January. The consumer sentiment reading from the University of Michigan fell from 74 to 71.1, and that was below expectations. Current conditions fell, expectations fell down into the 60s, and all of this really the downward move driven by inflation expectations. You just simply can't argue that inflation is on this path now to the Fed's target. The Fed can't argue that. The economy is expected to expand if aggregate demand is expected to go up. There's questions about how they're going to tackle this inflation issue. The administration seems to think they're going to be doing it with energy. Energy is a driver of costs across the entire economy, and can be easily impacted with supply and demand dynamics. That seems to be the focus. Drive energy costs lower, and we'll drive inflation lower. That is difficult. That is going to be a challenge, and that drove that sentiment a little bit lower. Existing home sales for the month of December up 2.2%. Kind of a surprise there. Look at the graph. Look at that chart just kind of going up and to the right. That was on top of a 4.8% gain in November. The annualized pace in millions, you can see up to 4.25, 4.24. Still well below where we were before interest rates started going higher, of course. In total for 2024, it was the third consecutive year of total volume decline in existing home sales. But this is the third monthly increase, the longest streak of gains since 2021. Suggests that sellers are relenting a little bit on price and recognizing that the higher mortgage rates are not about to go away soon. And sometimes people just need to buy a house. And so the reality of a 7% mortgage, which we've all had most of our lives anyway, seems to be settling in the minds of both buyers and sellers. But the biggest economic and market news over the weekend was a word most of us probably had never heard of before this weekend. And that's a Chinese startup company called DeepSeek, which works in the artificial intelligence, offers an engine similar to what we all know about now for the last couple of years, like a ChatGPT or any one of these things. But what was so disruptive about this news is not that there was a new entrant to the process, but the U.S. has gone to great lengths to try to ensure that the Chinese, our adversary in the world of technology development, that the Chinese do not have access to the fastest and best and most advanced computer chips, which drive AI search and analysis. So a very small startup spending reportedly less than $6 million. Compare that to the billions and billions spent by the likes of Meta and Microsoft, ChatGPT, etc., has developed a platform, an AI platform called DeepSeek, which reportedly is faster and better and does not require the highly expensive top-of-the-line computer chips that the U.S. has sought to have withheld from Chinese companies. Core features of DeepSeek are unprecedented real-time data aggregation, contextual highlights, predictive analytics, the ability to bypass traditional web indexing using direct partnerships, artificial intelligence-driven curation. And this really disrupted the market. And so this morning, big cap tech is selling off aggressively because big cap tech has had very high valuations. I've been talking about these valuations for weeks now, talking about the potential for a correction. We got a little bit. We had about 6% down in the NASDAQ. Then it kind of went back to almost a new all-time high. And now this is causing the market to sort of question the valuation metrics of big cap tech, given that they thought they had this protective moat, right? And the billions and billions and billions spent. Now everybody's looking at it and say, well, maybe we didn't need to do that. Maybe we could do more with these lower quality chips. And that's exactly what DeepSeek is reportedly doing. And the adoption of the DeepSeek surged over the weekend, was the top downloaded app on all of the smartphone platforms such as Apple. So this could cause very significant disruption for the incumbents in artificial intelligence. Alphabet, otherwise known as Google, Microsoft, etc. But now the market is reassessing this sort of monopolistic dominance, this economic moat that surrounds these companies. And the company at the very front of artificial intelligence is the company that makes the computer chips. That's NVIDIA. And they have tumbled today more than 20% as of the time that I'm speaking. If DeepSeek can deliver faster, better, cheaper artificial intelligence capabilities, but doesn't have to spend the big money on a computer chip that has a 90% profit margin, then investors will look at NVIDIA and say, well, maybe we shouldn't value it as high as we do. And then, of course, the stock would sell off. It also leads to questions about traditional ad-based search revenue streams, right? So, the Google's example of the world. And then, therefore, that spreads to the total valuation of all of U.S. mega cap tech, NASDAQ composite, et cetera. And we will be looking at this, but what we won't be doing is reacting quickly here on day one of this new revelation. It does show us some things, though. Number one, China has resources. China has engineering talent. China has capital. China has the determination to catch or really surpass the rest of the world, primarily the U.S., in all advanced technologies. This is the new sort of Cold War, or the race, if you will, like the space race from the 60s. It shows that artificial intelligence is still in its infancy, and that there will be changes in leadership, just like there was when, the railroads were being built across America, in the 1800s. Technology tends to have exponential advances and growth around innovation, and leadership can change very quickly. And I'm not convinced it's changed yet. It looks like it may have, but we need to learn more. And we're only about 48 hours into this, or maybe 72 since we first started hearing about it. We're seeing big sell-offs today in companies like NVIDIA, Google, Microsoft, and Amazon. They do remain great companies, very strong balance sheets. We call them fortress-like, immense talent, robust development pipelines, great products. But just this morning, this graph here is the chart of NVIDIA, and the intraday loss in the market value of this company is greater than the total market capitalization of all but 9 S&P 500 companies. There are only 9 companies in the S&P 500 with a market cap in excess of that $800 billion figure. So this is very significant, and we'll continue to be talking about it in the weeks ahead. Other data coming out this week, we had new home sales this morning. Durable goods, FHFA, and Case-Shiller home price indexes both reporting on Tuesday, along with consumer confidence. That's a follow-on to the Michigan report. The Fed meets this week, not expected to cut rates at all or hike, expecting nothing there, but maybe some more guidance and hopefully some clarity and some talk about their views on the directionality of core PCE inflation. Thursday jobs claims fourth quarter GDP expected to show a print of 2.6%, pending home sales down a little bit. Employment costs, personal income spending, and the big one, PCE, that's the Fed's preferred inflation gauge, expected to be at 0.3 for December versus only 0.1 in November. Not really good news for the Fed. I don't know if they'll have this number when they meet on Wednesday or not. I would presume that they could, but I'm not sure. Chicago PMI also on January. Thanks for tuning in. Available on all the podcast formats. Best place to catch me is on YouTube. The channel on YouTube is Slaying Bulls and Bears. Make the complex complicated simple and sensical. Thank you. I will be back to you again in 1 week.